In investing, one of the most important metrics you'll come across is the price-to-earnings ratio, or P/E ratio. It's a key tool that helps investors assess the valuation of a company in relation to its earnings. The P/E ratio tells us how much investors are willing to pay for every dollar of a company's earnings. But it's important to know that the way you analyze the P/E ratio depends on the sector a company operates in. Companies in the technology sector and those in the consumer staples industry have different growth prospects, risk profiles, and market behaviors. First, let's look at technology companies. These are typically high-growth companies, which means investors expect them to increase their earnings significantly in the future. As a result, tech companies often have higher P/E ratios, typically ranging from 20 to 40 or more. This reflects the belief that future earnings will justify today's higher price. Because of this, it's important to consider the forward P/E ratio when evaluating tech stocks. The forward P/E uses projected earnings, giving you a better sense of whether the company's future growth might bring down that P/E ratio to a more reasonable level. Now let's shift to the consumer staples sector. These companies, think household goods, food, and personal care products, are generally considered low growth but stable. Because these companies have consistent earnings and lower growth potential, their P/E ratios are typically lower, often in the range of 10 to 20. These companies generate steady profits, even during economic downturns, which is why they're valued more for their stability than for explosive growth. So, how do you compare these two sectors when it comes to P/E ratios? The key is sector context. You can't expect a high-growth tech company and a stable consumer staples company to have the same P/E ratio. Instead, compare companies within their own sector to get a clearer picture of whether a stock is overvalued or undervalued relative to its peers. To calculate the P/E ratio, you divide the company's price per share by its earnings per share, or EPS. For example, if a tech company's stock price is $100 and its earnings per share are $5, the P/E ratio would be 20. And if you're using future earnings estimates, you'd calculate the forward P/E ratio using projected future EPS. Whether you're looking at fast-growing tech companies or steady consumer staples, understanding the P/E ratio helps you make more informed investing decisions. It's a critical tool in comparing companies within their sector and determining how much you're willing to pay for a dollar of earnings. So remember, tech companies typically have higher P/E ratios because of their growth potential. Consumer staples tend to have lower P/E ratios due to stable but slower growth. Always compare companies within their sector and consider using the forward P/E ratio for growth stocks. Make P/E work for you in smarter investing decisions.